Rahul Singh, Head of Research with StanChart Securities, joins us. Rahul, morning. Thank you for joining us. How do you characterize the market environment, Rahul? Do you think the current decline in equities is a good buying opportunity, or this is beginning of the pain, and in the near term or in the medium term, we could be staring at some more downside?
Yeah, I think, good morning. I think you characterized it well before me, and the trend definitely, if you look at it from a macro perspective for India as well as globally, is definitely not very encouraging for equities. I think the challenge in India is that will the macro worsen from here? And will that worsening macro even take away the sheen from some of the sectors which have done well so far, namely consumer, pharma, parts of auto sector, and that's really the thing to watch out for, whether the macro worsens and makes India completely a market to avoid, or will we still continue to find stocks which have done well in the last 12 months and which will continue to do well, and which continue to do well if you look at the quarterly results in terms of some of the consumer names, the pharma names, and some select IT names. So I think that's where the challenge is. It's very difficult to give a broad market level where things can go down to or where things might stabilize. But the broader question which we all should be asking ourselves and worried about is whether that sentiment is going to sustain.
Now, if I look at the current market environment, the only positive here is that commodity prices have cracked. Crude is at a fresh 2012 low. How important is that? How crucial is that?
Yeah, I think I've always maintained that a little bit of slowdown in the global markets, including Europe, and triggered by Europe, is not necessarily a bad thing for Indian economy. It might be in the near term bad for the stock markets because of our current account deficit situation and the way rupee is positioned. But in terms of easing off inflationary pressures in the medium term, I think commodity prices coming off will probably, and I say probably, make RBI more worried about growth than inflation, and therefore we could be looking at slightly higher interest rate cuts, policy rate cuts, than what the market is factoring in now. We are factoring in only 75 bips, of which 50 bips has already happened in fiscal 13. But that could change if the global situation were to worsen, and if the inflation were to cool off dramatically, and RBI starts taking a much more pro-growth policy. And that could be, in the long term, in the medium term, after 12 months, be positive for the Indian equity markets.
Rahul, in this sort of a market environment, we are seeing that there is a big negotiation between growth and value. For example, in FMCG stocks, which traditionally promise growth, there's very little value on the table left because these stocks are trading at very expensive valuations. Where do you see a good growth value opportunity right now?
Well, I think you're right about FMCG, but I think within FMCG also we see some players, I mean, even within FMCG, the results have not all been unidimensional. We have had some results where we have seen some pressure on the discretionary part of the spending. So we continue to like, for example, Hindustan Lever. We think they are very well positioned for uptrading and the mass consumption growth which is happening at the mass level. At the higher end of the consumption level, obviously there is slowdown, which makes me little bit more cautious on autos and some of the more discretionary side of spending. In terms of where I see some reasonable trade-off between value and growth, I think IT services, some parts of IT services, for example, we like HCL Tech. We think there is a good top-line growth story there going for another 12 to 18 months. We still think pharma will continue to do well. Lupin, Dr. Reddy's Supply and Lupin are our picks in that order. So these are the other two sectors where we are kind of focusing on, apart from the consumer space, and that to select names in the consumer space.
Rahul, are you a bit surprised with the underperformance in banks? Commodity prices have cracked. Reserve Bank of India has cut rates, but from the credit policy, if I map the Bank Nifty and Nifty 50, the Bank Nifty has been a marked underperformer.
Yeah, I think what the market is now worried about is macro, because a weak macro, despite rate cuts and so on, will keep showing up in the NPLs and the NPS cycle, so to say, and that's where bulk of the worry is coming in, and also the fact that the credit growth itself could be under a little bit of a risk, and this is especially true for PSU banks. So, although the private sector banks have outperformed the PSU banks both in results, both in their quarterly results as well as in the stocks, as well as in the stock movements, the conviction is not there, and that's entirely linked to the weakening macro situation and the fact that a lot of things which we expected, the number one thing which we expected was a sustained rate cut cycle, starting with 50 bips and totaling up to 125, 150 bips during the year. That has come down to only an expectation of 75 bips totally, including the 50 bips which happened. And the other thing which was expected, if you go back in January, February time frame, was that at the policy front, things could start moving again in terms of the executive decision making, which has tended to get delayed because of the ongoing budget session and so on. So we expect that June is critical from that point of view for the market to take a judgment call on how soon and how serious the policy reform progress is going to be going forward in the next 6 months, that is June to December, which is really the window, if you see, before we start to get into 2013 and start to wait for the general elections in 2014. So the next 6 months are really critical in terms of how the banks perform.
Right. Rahul, so how exactly do you think, or when do you think the investment cycle will pick up?
Well, as I said, I don't think it's a function of interest rates alone. It's a function of the sentiment, the corporate sentiment, which is a combination of a lot of things, which is a combination of the policy, the certainty of the policy, and also the fact that they should see that demand should follow some of the capacity expansion which they are likely to do. So I think the first trigger for the capex cycle to start recovering, or for us to get excited about industrials and capital good names, is when government leads from the front and identifies certain projects which are flagship projects, and which it executes and starts executing at a speed which we have not seen in the last 12-18 months, and then the private sector would follow. I think that's what my sense is, and that's the signal I am looking at before I start to get more constructive on the capital goods sector and the industrial sector.
Let me split the large cap IT space into two parts. First, where there is visible growth, which is TCS and HCL Tech. Then B, where there is serious underperformance, which is Infosys and Wipro. So from a risk reward perspective, which is a better group, TCS, HCL, or Infosys, Wipro?
Well, I would split TCS, HCL also into two parts, and I would say HCL Tech still offers good risk reward. TCS is almost priced to perfection. Although the momentum is there, it's priced to perfection. And what the Cognizant result has shown, that some of the problems in Infosys and Wipro need not be company-specific structural issues. They seem to be more industry-wide issues, which might start impacting TCS at some point of time. Obviously, everyone has been fearing that, but it has not happened so far. It doesn't mean that the risk goes away, especially at the valuation at which TCS is trading in. So I would actually go with HCL Tech, within HCL Tech and TCS, and I would actually see Cognizant's result and guidance as a sign that at some point of time things would level off between these between the top three players, excluding HCL Tech. And from that perspective, Infosys does not look like a bad option if you're willing to take a 12 to 18 month point of view.
You said you like cement as well, Rahul. ACC and Ambuja, are you bullish on both these stocks?
Yes, cement we have been bullish on for the last, it's been one of our contrarian calls, and it has done very well for us, and we continue to stick with that. There are obviously some concerns around the CCI issue, but if you look at the price moves or the cement price increases, they have all been led by the fact that the weaker players or the smaller players cannot sustain their operations at lower prices. So there has been a good fundamental basis for some of the price increases which have happened in the cement sector. The utilizations have bottomed out. We have seen companies announcing capital expansion plans which will all commission in the next 2 to 3 years. So we see next 2 years the capacity utilization continuing to go up. And my other belief has been that if you have to start betting on the infrastructure capex cycle, cement is the place to start from, rather than buying the capital good companies, which will be much more high beta and high risk, given the uncertainties in the capex cycle and the uncertainty in the timing with which the capex cycle will recover. So that's the top-down view on cement, and also some of the bottom-up reasons why we like cement in terms of the sustained pricing power which we see.
Look at the Nifty, blink of an eye, and Nifty suddenly has appreciated by 20 points. Look at the intraday, and there you see a big pop. I'm not sure if the pop will sustain, but from the day's low, we are up about 20 points, and from Friday's low, it's a recovery of more than about 1.5%. 49.50. The challenge is that let's see for rest of the week, bulls, if they can really defend that mark off or that line of 4,900 on the Nifty. But that pop is strong, and the pop is courtesy buying in banks and courtesy buying in some of the large cap IT stocks. Rahul, final question on Tata Motors. Are you a bit surprised with the numbers JLR has reported at a time when US consumer is exhausted, European consumer is confused? What explains outperformance from JLR?
That's a good question. I don't think even the Tata Motors analysts are very sure of that. But I think what definitely is working for them is repositioning, market share gains, and they're coming off a lower base in terms of the way they are competing with the other luxury car makers, and that seems to be holding on pretty well, and that's something on which it's very difficult to put a finger on and say that how long it will continue or not continue, because it's a function of so many moving parts and the actions by the other strong the luxury car makers. It's from my point of view, I see still Tata Motors as the cheapest auto stock. It is not as much affected by the discretionary slowdown in India as the other parts of the automobile segment might be. So we continue to like Tata Motors even at these levels, and that's one of our top picks in the sector.